The central idea of modern monetary theory is that governments with a fiat currency system under their control can and should print as much money as they need to spend because they cannot go broke or become insolvent unless a political decision to do so is taken. Although modern monetary theory is not yet widely accepted amongst political thought leaders, the idea of running a large annual deficit even during times of strong economic performances has become an idea shared by both sides of the political aisle. This is a trend that's worrying Bridgewater hedge fund founder Ray Dalio, who sees more pain ahead. So this one's a tough video to make because you have a very brilliant investor saying that there is the potential for more pain on the horizon, but there are also opportunities, which is what we're going to discuss in this video. What's up, guys, and welcome back to the channel. And if you haven't done so already, hit that red subscribe button, or I swear to God, I'm going to start filming videos from the garage with my six-figure car in the background, just like those other cringy finance YouTubers. But what I'm worried about is that those car fumes are going to go right to my head to the point where I start shilling for FTX. All right, so let's dive into this. So Ray Dalio was actually interviewed by Barron's magazine or Barron's newspaper, and what he's saying, and I sort of alluded to it in the intro, is that he sees a lot more pain ahead. So exactly what is he talking about, and what kind of pain is he referring to? And I would say that the pain is even worse than the time that Peter Griffin fell off his roof in a shopping cart.
Okay, go!
So this is what they asked him. They basically said that, listen, you've studied the patterns of history to help you understand the present and prepare for the future. What does history tell you about the present moment and what might be happening in the years ahead? And so Ray Dalio came out and said that there's 5 big things that he's worried about. And the first major item is the big debt levels and debt increases that central bankers have been supporting by buying a lot of debt with money that they are printing. So in other words, what he's really saying is that he's worried about higher levels of inflation because we as a society have essentially become addicted to running a deficit even in good times. And that's an apolitical thing. Both sides are doing it. And so what happens in this environment? He didn't really dive into it in the article, but I'll try and explain it just a little bit. There's a lot to cover here, but I'm just going to touch on the major part. So you can see, and absolutely nobody's shocked, that the average rate of a 30-year fixed rate mortgage has jumped to the highest level since 2008. And one of the reasons, this is not the only reason, but one of the reasons why the mortgage rate has jumped to such a high level is, and I wrote it right here, is that when the largest buyer of mortgage bonds, which is the Fed, goes away, it pushes up the rates. And so that's what you're seeing here. And so if the Fed is offloading their balance sheet, or at least just not buying as much, there's just fewer buyers in the market. And if the majority of institutional buyers are not buying at the same rates that they were previously, then of course fewer buyers are going to cause the interest rates on these pieces of debt to increase. And so if we continue down an inflationary spiral, I don't know if we are, but if we continue down this road, you're going to see bond yields go higher. So what does that mean to anybody that holds sort of like fixed rate debt? The principal amount goes down in order for the bond yield to go higher. There's an inverse relationship there. And it might not just be bonds. You guys might hold some dividend securities. You guys might own some REITs. All of those prices are going to have to decline in order for the interest rate yields to be higher. But the other thing is, because we're in a higher interest rate period, these guys might have long-term contracts, especially like these REIT owners, but they have shorter term or not like termed appropriate debt. And so they might be getting squeezed on the cost end as well by having higher interest rate costs in general. And so their distributions could go down in this environment as well. So just be careful when you're dealing with fixed rate or fixed rate adjacent type securities. Now, if that doesn't make sense or you want a little bit more information, let me know in the comments if you guys want me to do a video on just sort of like dividend investing or fixed rate type investing, even like alternative types of investing that generally have a fixed yield. I can talk about all of that with you guys. Now, the second risk that Ray Dalio is afraid of is large internal conflicts within countries. And so the conflicts most threatening to our system, as said by Ray Dalio, are those between populists of the right and the left. And he believes that these conflicts have big implications for taxes and how the wealth pie is divided and how well the overall system works. Now, you guys might not realize this, but in 2021, and I'll show it to you here, 57% of households paid no federal income tax. So, you know, whenever there's talks about taxing the rich, I think this statistic goes underreporting, but I have to be fair. This, of course, does not mean that these people aren't paying taxes at all. They're just not paying income tax, but they are paying other taxes such as property taxes, payroll taxes, sales taxes, and other. But I did highlight here that, prior to the pandemic, it was only around 44% of households that paid no income tax. And of course, now that we expect 2022 to get filed, we can see that it's going to go back to that number. So approximately 40% of US households are expected to owe no federal income tax, which is down from last year. But once again, part of this reason is because in the States, you can itemize your returns, you can deduct other items from it. For example, you can deduct mortgage interest, you can deduct property tax, I think, etc., etc. But also, they're paying sales taxes whenever they consume, and they could also be paying capital gains taxes or taxes on dividends or other income that they're generating. So it's not that these households are not paying taxes, it's just one piece of the tax pie overall that they're not paying. But it is a big piece. Like, for example, Canada, I think the majority of our taxes are generated from personal income tax. And I think that's the same all around the world. And so it's just an interesting thing as the right and left continue to divide on this issue. Now, I don't know enough information about the US tax system yet, although I do hold a visa in both countries, Canada and the US, so I can live and work in both. I just know the Canadian system better. And in the Canadian system, you can see there has been talk about a wealth tax. This conversation is also happening in the US. And a lot of people might not realize, but the top marginal tax rates in Canada for most of the provinces are above 50%. So for example, in Ontario, the top tax rate is 53%, or I guess 54% when you round up. But I do have to say that that is the top marginal tax rate. So your blended tax rate will be lower than that because taxation works from a marginal perspective. So the first bucket of your taxable income is taxed at a lower rate, then the next one is taxed at the next rate, so on and so forth. But essentially, any income that you make over approximately $250,000 is taxed at that highest rate. So if you make $500,000 a year, half of your income is taxed at more than 50% if you live and work in Canada. And the point that I'm making is that as more and more countries continue to run deficits, you're going to see more and more types of taxes get instituted. Like, for example, in the US, they just instituted a 1% tax on share buybacks. In Canada, they did the same tax, but they put it at 2%, not to be outdone by the Americans. So we'll see how this tax system continues to unfold, but it's looking like we're going to be in a situation where there's just going to be more deficits being run, and thus higher taxes are going to have to get raised on the population. Now, a fun little fact is that a lot of people think that you can raise taxes substantially beyond 55 or so percent. Take a look at the Laffer curve, and really what it shows is that the overall tax revenues actually start to decline if you raise the taxes substantially beyond 50%. So 50% or just around that area is the highest you can raise the personal income taxes at. So essentially, Canada has pretty much maxed out where they can raise income taxes at, and so we definitely have to find other areas of taxation, like the share buyback tax, like the wealth tax, and also like reducing the amount that you can put in every year into our equivalent of your Roth accounts. Now, the third conflict that Ray Dalio sees is conflicts amongst countries as the world order shifts from being unipolar to bipolar. And so he said that throughout history, when the most powerful countries have roughly comparable power, typically there are international conflicts over wealth, power, and ideologies. And we're kind of seeing all of that happen all at once right now. So the two major conflicts that we're seeing, or potential conflicts that we're seeing right now, are between Russia and NATO, and of course, as every Alibaba investor knows, between China and the US. Now, they have tried lately to sort of simmer down the tensions, and so I hope they continue to do that. But the bigger issue is that the governments are being led to prioritize self-sufficiency, i.e. the CHIPS Act, and military spending over producing efficiently, which is causing supply chain problems that are lifting inflation. It also increases the risk of military war. And so we're seeing all of that right now. China is massively investing in its military, so is the US, are sort of decoupling at least a little bit, and so we're starting to see some of these issues play out. And if it plays out the way that Ray Dalio is worried that it'll play out, it will lead to higher levels of inflation. Of course it will. And of course, as early as today, you guys might recall that it almost felt like we were going into World War III yesterday, but Poland's president came out and said that the missile that killed the two people in Poland was likely fired by Ukraine in defense against a Russian attack. So I can't remember the last time Europe was this close to entering a world war in my lifetime, and I really hope it never gets that close again, to be honest. That was too close to handle. And if you've been asleep or you're just new to this channel, you may have missed the fact that China has rejected understanding with the US on Taiwan. Now, despite the fact that Biden and President Xi Jinping had a good meeting, they still are at odds with their belief on Taiwan. China, this is an older article, this is before their meeting happened, but I believe that it still stands that China has exerted pressure on Taiwan, including the possibility of using force to achieve its goals. And so, once again, China has not backed away from their claim to Taiwan. They absolutely believe in a one China, two sort of rules of government approach. But there's a lot of people, and you'll see it in the comments of this video as well, that accurately say that don't believe China when they say that they want two systems. Just look at what happened in Hong Kong. And in fact, I don't think I've ever seen protests with that many people. Now, there are two more forces that he did mention. The other two forces are, one, there could be severe acts of nature such as droughts, floods, and pandemics. And the one thing that I would want to mention about pandemics is look how expensive this last one was. What happens if there's something more severe? If we're already running budget deficits and we're already spending more than we have, then what happens if something more severe happens? I think the reaction to it could push us into higher levels of inflation, higher levels of economic uncertainty than the pandemic itself. And the last thing that he commented is actually a good news type of story, is that man's ability to adapt and invent new technologies is the greatest force and is now better than ever. And so here's your silver lining, because he's saying computers are helping us think better, and the development of the venture capital markets is providing inventive entrepreneurs with the resources to try out their ideas, and if they pass muster, bring them to scale. And so this is why when we focus on investing, at least on this channel, I try to focus on future focused type companies. So that's why when I was looking at the chip makers, I was looking at the designers that were most future focused. That's why I really liked AMD and Nvidia. I don't own any of them yet. However, that's kind of like the direction that I'm looking at. I really love future focused technologies that are cheap today and give you a strong yield. That's why I'm such a big bull on Alibaba. It's just a future focused company that you can get cheaply. If I could get behind the metaverse, of course I'd be buying Meta hand over fist. I just don't see it yet, but I'm starting to sort of see it more and more as I'm doing more research. Of course I love Google. I love their valuation, or Alphabet. This is not recommendations to buy any of these stocks. Don't listen to YouTubers. You guys learned that lesson pretty well over this past week or so. And I guess the other name that I really would like to buy, it's another future focused company, is Microsoft, but I just got to get behind that valuation. And so until then, I'm just going to use call spreads on their acquisition of Activision, which hopefully if it goes through, my portfolio overall will show a 30% gain this year. Now, the next question that was asked from Ray Dalio was, based on your study of history and cycles, which parts of the world look attractive from an investment perspective? And what he did say is that while one does need to invest in the reserve currency countries with large market caps, which include the US, Europe, and Japan, he does really like emerging types of opportunities. He likes Singapore, but when it comes to like the Southeast Asia, he likes Indonesia, Vietnam. Of course, in South Asia, he likes India, which will have the highest growth rate of all countries over the next 10 years. And he likes the parts of Middle East and North Africa. He also believes that it's very important to have some money invested in China, which is very attractively priced at the moment. So it's not just Michael Burry that thinks China is cheap. It's also Ray Dalio that believes that China is cheap. He also likes Mexico because their labor costs are now relative to China. And India is the next frontier, which I will be allocating a large part of my portfolio to. I just don't know enough about the country, but every day I'm doing a little bit more research on it, and I just have a little bit to show you on the country.
Reasons why India might become the largest economy. India believes it will become the world's largest economy by 2047, surpassing China and the US. When it comes to the world's strongest economies, the United States and China tend to dominate discussions, but India is beginning to shift the focus due to their incredible economic growth over the last decade and their limitless potential for the future. India's primary asset is its people. India's people are generally much younger than China's aging population. About 65% of India's total population are younger than 35. India's workforce has unmatched potential, due to its size and current economic climate. Another indicator is India's economy is improving as poverty rates fall. However, according to the United Nations, India has lifted 415 million people out of poverty in the last 15 years, that is between 2005 and 2021. Increased urbanization is another piece of evidence for India's potential economic growth. Economists predict that China will overtake the United States as the world's largest economy by 2032, and that India will surpass both the United States and China by 2050.
And so more to come on India as time goes on this channel. But the real question is, what about China? What exactly does Ray Dalio think about China? And that was their next question that they asked him. And so they asked, many people consider China uninvestable because of authoritarian rule and government meddling in its markets. Do the current prices discount those risks? And Ray Dalio went out and said that China is going through some significant changes that most people have exaggeratedly bad interpretations of. So there are some great values here, and we're probably close to being past most of the selling. And so because it's the main competitor to the US, in most ways, it's a good diversifier in a world in which such competitions exist. But the major thing that he didn't mention there is that Ray Dalio's favorite YouTuber is actually psychotic and obsessed about China. And if you don't know who that is, I'm going to show you his channel right now. So there's this crazy psychopath by the name of Moore Money. If you haven't subscribed to his channel, subscribe now. And this YouTuber is an absolute psycho who does not stop talking about investing in China, and he discusses all of their risks and mitigation strategies. So if you're not subscribed, please hit that subscribe button now. Otherwise, this YouTuber may take on an FTX sponsorship. Now, the next question that he asked is, what are the implications of today's high debt levels and money printing? And so what he's saying is that when interest rates hit 0%, and there's a deflationary debt crisis, central banks have to print money and buy or guarantee debt. This leads to reflation, which inevitably becomes excessive, which leads central bankers to tighten monetary policy, which leads to the opposite happening. And so now we essentially get into this balancing act. And here's where you are hearing the Fed talk about a smooth landing. But this is what Ray Dalio says about that. When the balancing act is difficult because both debt assets and debt liabilities are very large, central banks chart a middle course between too high inflation and too weak of an economy, which leads to stagflation, which is what he believes is happening now, and I agree with that. I do believe that we're entering a period of stagflation, if we weren't already in it. But don't listen to me. Here's Ray Dalio on that point.
Quickly on inflation rate, how concerned are you about it?
I'm significantly concerned about it because the amount of money and credit that has to be produced and is budgeted is a large increase. And yet, if it's not spent, it produces its own problems. The markets have a sensitivity to that. So what it means, and then there's a supply-demand picture for bonds. And the way it looks is if you should get the selling of bonds, it worsens that supply-demand picture, because the way it works is the Treasury borrows and runs a deficit, but it can't produce money. So it has to sell bonds. And when it sells bonds, if there are not enough buyers of those bonds, then the Federal Reserve got to come in and print money and buy those bonds. And the world right now is over invested in US dollar denominated bonds, pension funds on the 60-40 mix, and they have negative real returns. And cash has a lot of negative real returns. So if there was a selling of that and a moving to other assets, stocks, other assets, commodities, other assets, or other places, other currencies, other real estate and the like, that selling worsens the supply-demand picture. And then if there's not enough demand, that means that the central bank has got to come in and print more money. So yes, it's not only the inflation that's in the pipeline or projected in that supply-demand balance, but it's also what it could be if there's a selling of debt instruments.
So the next question that Barron's asked him is, what do you think about the rate increases? Like, are they going to level off or are they going to continue? And what are your thoughts on inflation? And so Ray Dalio said that right now the interest rate is probably in the vicinity of 4.5% to 5%. And he believes that many households aren't having problems yet. Keyword yet. But that probably won't happen for another 9 months. So effectively what Ray Dalio is saying is that sometime in the second half of 2023, the average household will start having problems. And so I would at least recommend you guys all have a nest egg just in case if you are laid off. You should always have a nest egg of cash lying around just in case if you do get laid off. Now, one time in my career, I actually did get laid off, but I didn't really worry because I had around a year or two of cash set aside just in case of that happened. And I do recommend that everybody have something set aside, especially if you have young families and you want to make sure that you don't lose the house or anything in that type of environment. So just be careful. Ray Dalio is predicting that the average family is going to start struggling in 9 months. Make sure that that's not you. You got some time to prepare. So start saving as much as you can. You absolutely don't have to invest everything into the stock market. Even in early 2022, or I guess mid 2022, I don't exactly remember when, but people were saying, oh, you know, inflation is running at like 8%. Make sure that you put all your money into the stock market because you're going to devalue it just by holding it in cash. One of the best places to have held your money was cash in this environment because the stocks just went straight down. So what I'm saying is that don't worry about the devaluation of cash when it comes to just having enough of a nest egg to make those mortgage payments, to keep food on the table and all of that other good stuff. Just keep yourself safe, guys. That's what I always recommend. Be more conservative than aggressive, in my opinion. Always plan for a rainy day. Rant over. Now, I guess some of you guys are wondering, how bad does he think things are going to get? And so this is what he said. The federal government is running a budget deficit of about 5% of gross domestic product, which means it has to sell bonds equal to 5% of GDP. The Fed is shrinking its balance sheet by selling or letting run off its current bond holdings from prior QE programs. There aren't enough buyers for these debt assets at current prices, which will equate to prices falling and yields to rise. This relates to that chart that I showed you previously about the mortgage rates rising. So effectively what he's saying is that there is no end to spending needs. So running that deficit of about 5% of gross domestic product is going to continue to happen. Countries don't ask themselves how much they can afford to spend because they can borrow and print money. And so what this is doing is that it comes at a cost, and the cost is in the form of devalued money and devalued debt assets. We should expect more of that. So in other words, what he's saying is we should expect more inflation. And if you haven't heard the term financial repression, now's the time to look it up. If you want, search on my channel. I have 2 videos about financial repression. Cumulatively, they both got a total number of views of around 200 views. That's how little people care about financial repression, but it's going to be a very important topic as time goes on. And so, of course, the natural question is, how should investors be positioned in this new environment? And that's exactly what they were asking here. And so he said, there's a saying in the market that he who lives by the crystal ball is destined to eat ground glass. So effectively what he's saying is that it's difficult to forecast it. And of course, don't assume cash is a safe investment. And I don't believe cash is a safe investment, but I do believe you have to have a nest egg just in case if you lose your job. So I do believe that he agrees with me on that too. Why wouldn't he? Now, the world is leveraged long. In other words, most investors are long assets with borrowed money supporting those positions, which is a formula for a shakeout as prices go down. After they get squeezed and have to sell, or when the Fed starts printing money and monetizing debt again, that will be the time to buy. So, like I've been saying to you guys since at least 2021, I sold most of the portfolio in 2021 while everybody was shilling these expensive tech names and crypto coins and whatever. The only thing I was doing was selling off my portfolio, going into around 70% cash, and then I really just got bored. And so what did I do with my time? Some of you guys that are new to the channel, I just started learning how to smoke meats, and I started baking. I started making cake pops. I got really weird. It was a really weird time for me, but now that the markets have started to decline, I have started deploying assets into the market. I still think a lot of stuff is expensive. Don't get me wrong. The market's down 15%, but it's not down that much relative to where the valuations were previously. And so I'm just not seeing it on a granular perspective yet. I'm still around halfway in cash. And so as these things continue to come down, I'll keep buying up more securities. And I've already told you guys what's on my wish list. But the number 1 and number 2 companies are, of course, I really like Microsoft. I really want that price to come down. Alphabet's kind of getting to where I'd like to purchase it. Alibaba, of course, I might buy more of it as time goes on if it just stays lower for longer. I'm kind of praying that it does stay lower for longer. I know a lot of you guys are sad that it hasn't run, but how great would it be to buy a wonderful company at an exceptional price and have it stay at that price, so as you sort of generate more capital through employment or whatever, you can just keep buying it. Let it run after like the next 10 years or so. I'm happy to just keep buying that name. And when it comes to people feeling the pain, we are starting to see early indications of that pain. Mortgage applications have started to decline. People are experiencing it, at least early on in the mortgage sector, and I'm going to show you a news report which sort of talked about that.
Clearly, the Fed is not beating inflation yet, but they are winning the war against an overheated housing market. Today, some new numbers showing mortgage demand slowing yet again. Mortgage applications decreased 2% from the prior week. That's according to the Mortgage Bankers Association. These higher rates now at 6.81% on the 30-year, the highest since 2006, really took a hit on demand for refis, though, down 86% from the same week last year. Question now, is there any good news amidst all this housing carnage? It's a glimmer. Some deals can be had. Realtor.com out with the 10 cities where prices are falling the fastest, and topping that list, Austin, Texas, where, listen to this, prices are down 10+% since June. Phoenix, Arizona, just behind them at 9.9%. Palm Bay, Florida, Charleston, South Carolina, Ogden, Utah, they round out the top 5. Denver, Stockton, California, Durham, North Carolina, Spokane, Washington, also in the top 10. You might think those are the 10 cities where prices grew the fastest in the pandemic. That's not necessarily the case, Shauna. There certainly is some overlap, notably Phoenix, Austin, and Denver, but most of those cities were in Florida, where prices are not falling that fast because we're still flocking to the tax rate.
And what I really wanted to do is I wanted to end off this video with a short clip of Charlie Munger talking about inflation. Take it away, Charlie.
Do you think we should still be using that weapon aggressively, which is what President Trump would like to see happen? He wants them to cut interest rates again, I think he said by 1%, and also push up quantitative easing once again. Build up the balance sheet.
So afraid of a democracy getting the idea that you can just print money to solve all problems, and eventually I know that will fail.
And if we keep at these extraordinary measures for the Fed, I guess not just the Fed here, but central banks around the globe.
Yes, but who knows when money printing runs out of control? And at the end, if you print too much, you end up in something like Venezuela.
You're not suggesting that happens anytime soon?
No, but I don't like the idea. And both parties, you get politicians say, what we've learned is we can print all the money we want.
Right.
We don't have to raise taxes, we just print.
And so it's clear that Charlie Munger shares my opinion that both parties, or we as a people, are addicted to free money right now, and the results could be disastrous. And so it's something we have to pay attention to, and we have to pay attention to it as we invest our portfolios. Now, if you haven't seen my preview for Alibaba's results, which do come out tomorrow, you can get to that video right here.